What's up, everybody? I'm Dave, the Military Millionaire. Today we're going to touch base on my thoughts about whether or not a recession is coming. And if I'm being honest, I'm absolutely sick of seeing these videos for the last 4 years and all the crash hype and the recession hype and the emotional fallout and damage. But I get asked all the time for my opinions on this, and I thought, it'd be easier if I made a video, and then when people ask me, I can point them to the video rather than giving the same kind of long-winded answer every time somebody asks me, right? It saves time, and saving time is a very valuable thing when you're busy trying to build businesses. First off, the answer is recession coming. Yes, eventually, because that's how history works. And if you work at booms and busts and cycles, then there's always a recession coming. Even right after a recession ends and the market starts to go up, there's a recession coming. So you never know when that is. And so if you're investing in a way that doesn't account for future recessions, then you're not really investing, you're speculating or gambling, and you're trying to time the market, and it's not going to work out well for you. So, prime example. People invest in their TSP for the last 5-10 years, and everybody tells me as I'm saying, invest in the TSP. They're like, wow, that's such great advice. Look at all this money I made. The market's great. Oh my goodness. You're silly if you don't invest. And then what happens last month? The market drops 30 points or 20 points or whatever, right? There's a substantial decrease in value in the stock market. And all of a sudden, people come running to me. Oh, what do? I got to pull my money. I got to move my funds. This isn't working. This is broken. The system's broken. 401ks are dead. The sky is falling. And then on my TikTok feeds, it's people saying the TSP is the worst investment ever because of this downside and all this other stuff. And they almost overnight forgot the amount of growth they had over the last few years. So prime example, I've put I had $50,000 or $60,000 in that account in 2019. I maxed it out, so I've probably got about 80 worth, but it was up to 120. It's now down in the 90, 95, but even at 90, 95, the bottom or the low recession, I'm gonna pause that for 2 seconds. Hey.
A few inches later.
But even at 90, 95, the bottom of the recession, that's still more than a 15% increase in value over the last 2 or 3 years, which is pretty decent. And get this, it'll go back up. So anyone who's trying to tell you that the market's doomed because of this has not done the part where they take history and look further back. Because if you look at the stock market over the last 100 years, dip, but each dip is higher than the past. It keeps climbing. So you got to stay the course. So what I'm saying is, don't pick investment strategies that won't work regardless of recessions coming. You need to invest in ways that account for the fact that recessions are going to happen, and then you need to maintain those strategies even when the going gets rough. So if I was still active duty, I would still be contributing to the TSP regularly, and I wouldn't have changed my allocation. Right? If you sell because the market dropped, you're taking a loss. If you leave your money there, you're going to be fine. And if you keep investing as the market drops, then it'll go back up eventually. And when it goes back up eventually, you will have bought a whole bunch of stocks at a discount. That's called dollar cost averaging. That's the way to do it. So, is the recession coming? Absolutely. And if you read Ray Dalio, Big Debt Crisis, or any other books about recessions and markets and economies and whatever, there's always a recession coming. There's like an 8-year cycle and a 15-year cycle and a 40-year cycle and all these different cycles about all these different things. I agree, there's a recession inbound. There has been for a little while. Is that going to be a real estate crash? I don't know. So here's what I'm seeing and feeling, right? And we're going to do that. We're not going to do all the data and all the chaos because it changes, and I'm kind of sick of people tweaking data to meet their narrative and confirmation bias and all that stuff. So what I'm seeing, what I'm feeling. Interest rates have climbed. That's got people a little bit on edge. There are some companies that have done some layoffs. Mortgage companies did. There's a couple big mortgage companies that did layoffs here in the last little bit because when rates climbed, they lost refinancing as a consistent part of their business, which had been more than half of their business probably for the last 2 or 3 years. But most of those people already refinanced, and now with rates where they are, it doesn't make sense to refinance again. So that part of the business is going away. So they're they're laying people off, right? Kind of a normal cycle. But that doesn't necessarily mean that the market's going to crash. The interest rate doesn't necessarily depict the entire market, right? There's investor sentiment, there's all kinds of stuff. As interest rates climb, it'll slow inflation. It'll be a little painful. It is what it is. But as long as you're buying deals that make sense, you'll be fine, even with a higher interest rate. People have been buying houses for a long time, including buying houses in the 80s when interest rates were double digits, right? 10, 15, 18% interest. And so, yeah, I'm feeling a little bit of nerve there. But at the same time, I listed a property for $215 on a Monday a couple weeks ago and was under contract for $228 with a $15,000 appraisal gap Tuesday afternoon with like 15 offers. So I don't really see the crash coming just yet on the real estate side, and I'm still buying deals, but I'm buying deals that make sense. I'm paying under market value for off market properties. I'm refinancing them, then I'm putting a mortgage on them. I'm maintaining some reserves. They're renovated, they're cash flowing pretty well, and I'm going to be okay holding them for the long term. So even if the market dips, that's okay because you're holding the properties long term, and when the market comes back up, you'll be good. And usually rents don't dip much, if at all, during a recession unless it gets really, really, really bad. And rents lag. So if rents do dip, it'll be, a year down the road when that lease comes back up. And so I'm feeling good about a lot of that stuff. So here's what I'm doing, right? So let me make sure I'm not missing anything in my notes about what I was going to talk about. Yeah, so how am I adjusting my investor strategy right now, right? Currently, I'm not actually dollar cost averaging into the stock market, and that's not because I don't believe in it. In fact, I'm actually kind of kicking myself for that, but my goal this summer is to pay off any and all bad debt that I had remaining from a couple flips that, I had to take a little extra out for going over budget on rehab. And so I've got a few projects closing. Once those projects close, I'll have all my debt paid off. And then at that point, the plan is definitely to take a little bit of the excess every month and dollar cost average it into index funds. And I'm going to look into doing a solo 401k or whatever, right? Where I'm investing more than the $6,000 limit and I can still get some advantages. And so I definitely plan to continue investing that way. Just got to store some capital to finish some projects. And then what I'm going to do is I'm going to have a little bit more liquidity. So I'm going to beef up my reserve account so that, if something happens, I can weather a storm. And then I'm going to build a little bit more of a cash position just so that if there's a recession, I have some money on the sidelines to take advantage of some of those opportunities. But I'm going to continue buying properties. Off market at a discount that makes sense, that are under market value, so that when I renovate them and I refinance them, I'm not overpaying for a good property. And then I'm going to maintain, like I said, good reserves. So really all I'm doing is getting a little bit more conservative. So instead of going 85% loan to value on every single loan, I might back that down to 75%. And instead of not having a massive cash reserve so that I can keep rolling into properties, I'm going to build the cash reserves up more. And instead of using other people's money for all of my projects, I'm still going to do that, but I'm going to budget so that I can build up my own money so that if that dries up and people aren't doing private lending anymore, or there's a recession, I have money on the sideline that I can use immediately for opportunities. All right, here's the most important things, right? So is there a recession coming? Yeah, sure, but who knows when? And anyone who tells you they know when or they know what, do I feel like things have shifted a little bit? Yeah. Can I put a finger on why? No. Am I having Jay Scott come and talk to my mastermind group next week to give this a presentation on this and his thoughts about the market and different investing strategies? Yes. If you'd like information on that, go to my website and check out the mastermind application under the resources. It's for service members and vets who are serious about real estate. But the important thing is this. and you should invest this way anyway, but especially when you think that a recession is looming, you need to be, Warren Buffett has his rules of investing, right? Rule number 1, never lose money. Rule number 2, repeat rule number 1, right? That's it. If you focus on the recession as investing in things where your risk is hedged, you'll be okay. Where people get into trouble is when they invest in things where their risk isn't hedged or they panic sell. So if you're in the stock market, it drops and you panic sell, that's bad. If you're in the stock market, it drops and you leave it alone, that's good. Now, if you're in individual companies, then the risk might be a little bit different because if that company goes bankrupt, that's a whole different story. But if you're in like a total stock market fund like VTSAX through Vanguard, that index fund, then if one company goes down, hey, they'll move the money into another company and you'll move on with your life and it'll still continue to be a win in the long run, right? But you got to invest in risk hedging, right? So the biggest thing that you need to focus on in the recession is having those reserves, having strong financials, having good cash flow, making sure that you can hold on to that property or that asset no matter what, and betting on things where you can't really lose, that barbell strategy. So you might lose $50, you might lose $100, but if it goes the other way, your upside is 500, 1,000, right? Just that, what do they call it? Asymmetric returns. There we go. So those asymmetric returns where you have a low amount of risk and a high upside. Some other things you can do if you're really, if you've got a really strong cash position, maybe as rates climb, you invest in bonds or certificates of deposit. They haven't been great for a long time, but if rates climb on those, they could be a pretty decent return and they're not going to lose money. Or a savings account, or, I like real estate as long as you bought it right. But you should be looking at things where your risk is very low and your potential growth is very high, always. But more importantly, when you think you're going into recession, is just making sure that you can weather the storm. So investing in things that aren't going to cause you to lose your shirt, having good reserves. So that's the, and I think I'm trying to think of maybe it's, the actual name, but this wonderful author that we love, Nassim Taleb. He talks about this, and a great example of this is a book, right? A book has virtually no risk. You read the book, maybe you don't like the book, okay, that's your risk. You lost some time reading a book you didn't like. But the upside is huge. If you learn something valuable from that book, it'll pay dividends for the rest of your life. So that's kind of the example you want to go into with investing, especially right now, is what is the worst case scenario with this property and can I weather that storm? Great. Okay, cool. But what's the upside? But instead of focusing on what the upside is and ignoring the risk, you need to focus on the risk and make sure that there's an upside there as well. So that's what I'm doing. I'm just a little bit more conservative on things, paying off any bad debt that I have left, maintaining larger cash reserves, maybe paying down a little bit of my properties to increase that equity, but I don't really think so. Just probably on my refinances, I'll probably just refinance out my cost rather than refinancing the full loan to value that I could, and just leave the money in there as equity. But yeah, that's where I'm at. And then I think there's 1 or 2 properties that I'm thinking I might pay off. Normally I don't pay off any properties, but there's 1 or 2 that I'd like to pay off. Yeah, it'll help the cash flow a little bit more, but it'll allow me to have a business line of credit linked to those so that it just gives me the opportunity to utilize a little bit more capital if something goes down, because I can tap into the equity of those homes quickly. The downside of that is the bank could call the note if the market does tank. So, lines of credit always have that risk. But anyway, this is my thoughts on, is a recession coming? Yes. Do we know when? Who knows? What am I doing? Same thing I've been doing, just a little bit more conservatively. And that's it. So not some crazy hype, clickbaity crash video, but I hope you got something out of it. So make sure you like and subscribe.